If you've ever thought you couldn't donate your property because you still owe money on it, this video is for you. If you've wanted to make a meaningful gift but needed some of the proceeds back, this video is for you too. And if you own property with partners where some want to donate and some don't, stay with us. There's a solution here you may not know exists. Most people assume real estate donation is all or nothing. You either give the whole thing, free and clear, or you can't participate. That assumption is wrong. And it's keeping a lot of generous people on the sidelines. Today we're going to talk about a giving structure called a bargain sale. Tax professionals know this term well. Most donors have never heard it. By the end of this video, you will, and you'll understand exactly how it works. So what exactly is a bargain sale? A bargain sale is where a donor gifts a portion of their property's equity to a charity and receives the balance in cash at closing at a negotiated discounted price. That discount is the gift, and that's exactly why the IRS calls it a bargain sale. This structure is well established, with roots in federal tax law going back to 1917. The donor's tax deduction is based on the full, appraised, fair market value of the property, less the cash they received at closing. Now let's talk about why this matters. Because most people assume donating property is an all-or-nothing endeavor, and that properties with a mortgage can't be donated. The bargain sale opens that door to many more people. Let me give you 3 situations where this changes everything. First, the property with a mortgage. You own real estate worth $1 million, but you still owe $400,000 on it. Under the old assumption, you can't donate it. Under a bargain sale, the mortgage is paid off at closing and treated as your cash back in the transaction. The mortgage isn't a barrier, it's just a number that gets handled at close. Second, the donor who needs cash back. You're not in a position to walk away with nothing. Maybe you need liquidity. Maybe it's part of your retirement picture. A bargain sale lets you negotiate a cash payment from the charity while donating the remainder. You decide what percentage makes sense for your situation. There is no fixed rule on the split. Third, the property with multiple owners. This one surprises people. Say you own a property with 2 other partners. You want to donate your share. They want cash. A bargain sale can accommodate all of you in a single transaction. You don't all have to want the same thing. The bottom line, bargain sales open the door to donation opportunities most people never knew existed. Let's put some numbers to this. You own a property. A qualified independent appraiser values it at $1 million. You and the charity agree on a total consideration of $500,000. That consideration might be a mortgage payoff, cash back to you at closing, or a combination of both. The gap between the appraised value and the consideration, that is your charitable contribution. Your tax deduction is based on that full $500,000 contribution, subject to standard charitable deduction adjusted gross income limits. Your CPA will calculate how that applies to your situation. Now here is where it gets compelling. In a properly structured bargain sale, the donor generally recognizes capital gains tax on the consideration portion of the transaction, not on the full property value. The donated portion is generally not a taxable event. For a highly appreciated property, that difference can be substantial. For donors who have held property for many years with a low-cost basis, think land or a property held for decades, the capital gains savings can be especially significant. Donors with property acquired before 1985 that was subject to accelerated depreciation should be aware that a portion of their charitable deduction may be reduced by depreciation recapture rules. The final tax result depends on the specific facts of your situation, including your cost basis, depreciation history, holding period, and how the transaction is structured. These are good reasons to sit down with your tax advisor before you proceed. One important point on your deduction: it is based on the full fair market value appraisal, not the price the charity resells the property for. Charities often discount their resale price to reduce hold time and eliminate risk. That is their business decision. Your deduction is based on the appraisal. That said, if the charity resells the property close to the donation date for significantly less than the appraised value, the IRS may look at that resale price if reviewed. That does not automatically mean the appraisal is wrong or will be contested. But it does mean the appraisal needs to be well supported, independent, and professionally prepared. Let's talk about how these transactions actually close, because it's different from a traditional real estate sale. Managing property and carrying ownership risk is outside the mission of most charitable organizations. So in many bargain sale transactions, the charity may identify a resale buyer and coordinate two separate closings in sequence. The charity closes with the donor first, takes title, then closes with the resale buyer. This is a normal and efficient real estate practice. But IRS rules are strict about who is treated as the seller in a transaction. If a donor locates their own buyer and routes the transaction through a charity, the IRS can challenge the capital gains treatment under the prearranged sale or the anticipatory assignment of income doctrine, a topic beyond the scope of this video. So, the charity must be the bona fide seller in the resale transaction. A properly structured bargain sale is designed so the charity finds the resale buyer independently, after the donation agreement is signed, with no involvement from the donor. The donation contract is not contingent on a resale. These distinctions matter. This is one reason working with an experienced real estate donation program is important. So, in summary, a bargain sale is the middle ground, a flexible structure that can create liquidity for the donor and meaningful charitable impact at the same time, and a well-established structure with roots in federal tax law going back to 1917. If you want to go deeper into key compliance issues, we have additional videos covering substantiating your deduction with the IRS and a deep dive into IRS gift appraisal requirements. Links are in the description below, and written guides can be downloaded for every planned giving educational video. And as always, consult a qualified CPA, attorney, or other tax professional before proceeding with any real estate donation transaction.